Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here on Monday, March 14th, 2022 with the Forex Trading live market analysis for you. Excuse me. And we have a lot to go over today. Before we get into everything, I want to show you our disclaimer to remind you that this webinar is for illustrative and educational purposes only. And if you haven't done already, we would like you to check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. So we may be talking about some of these patterns as we get through this webinar. All right, so with that, let's get on to our slide live action. Here we go. All right, so a lot of you guys are always saying, how come we never get to see your face in your videos? Well, usually I don't like to take up much of the screen and use more of it for the webinar, but here I am today showing you my face while we walk through this analysis. So if you haven't done so already, please make sure you hit the like button and the subscribe button on either YouTube or Twitch, however you are watching us today, and also make sure you tell your friends in the trading community about us as well. So, all right, so now we are going to talk about multiple currencies today. We already have the from the market analysis tab, our Forex Trading Unlocked workstation page pulled up. We're going to skip past the numbers. There are definitely economic numbers and things to pay attention to this week, but we're going to jump right into what's going on in the marketplace. So, and by the way, during this webinar, if any of you have any questions or comments or want to chime in about anything, just leave it in the chat. And as we get through these markets, we will segue into your questions as well. So we definitely want to appreciate any questions and comments that you have. All right, so for the Euro US dollar, as you can see, it's slightly positive on the day. It's bouncing back. I would be very leery of any type of rally right now. Remember, the market is trending lower. So the key thing is to be mindful of the long-term direction, which is definitely bearish. Obviously, we have a lot of things going on in the Ukraine that could impact what's going on with the next couple weeks of trading. We know that this Ukrainian thing is not going to end anytime soon. It would be nice if they could mitigate things down into a ceasefire and then some sort of resolution, if you will. That remains to be seen as to whether or not that does occur. All right, so right now we do have bearish pressures. Fundamentally, obviously, we have the war in Ukraine that is going on. The sanctions that are being imposed on Russia, as the news will have you believe that it only hurts the Russians. However, it does impact the EU. Sanctions on Russia hurt the trade with between the EU countries with Russia as well. So that means that as long they are not just not buying their products from Russia, they are also not selling products to Russia. The one thing that people overlook is the fact that Russia doesn't have a debt, unlike the United States and most countries around the world. So are the sanctions hurting them? Sure. But then with the price of oil and the fact is they are still selling oil, that is funding the war. So these are all things we need to take into consideration. The energy factors, the cost factors of everything that's going on in the EU is weighing on the strength of the currency. We have a Fed week this week. That's why I'm not going through the numbers, the economic numbers for the week, because everyone knows that we are watching the Fed. Odds are is that they will be raising rates a quarter point. Now, do I think they should do it? Well, I think they should have been doing it a long time ago. Do I think a quarter is enough? No. I think the smartest thing they could do is to shock the economy and do at least a half a point. I would think that even a 3/4 point move instantly would not be a bad move. Many pundits right now would say that would be crazy, but the reality is I come from an era where that was happening. They did unannounced Fed releases where they would raise or cut rates by half a point in the middle of the week, without any Fed meeting. That was during the Volcker eras. So the fact is, can the market sustain it? Absolutely. The markets are much bigger than they were before. So if they could handle it back in the 80s and the 90s, I think that they should be able to handle it in the 21st century, especially considering the volatility we have in the bond market, which we will review a couple things about that. So let's hit the Euro US dollar as far as what's going on with this trend. All right. So we have the downward trend. We just came off a lower move high. So we have lower move lows and lower move highs that we continue to make. And this high that we set back 2 sessions ago was a nice little bounce. I remember after we had this little 2-day upswing, everyone was getting very positive on the euro, very negative on the dollar. It seems like no matter any time the dollar sells off, even remotely, everyone wants to call the sky is falling, the dollar is coming to an end. But right now, considering what's going on in the world, and especially with all these sanctions put on globally, we're getting artificial strength in the US dollar by default. And then also because of these sanctions and because of the lockdowns and the impacts of supply chains, blah, 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 we all know what's going on with that, and inflation and commodities, it's definitely causing a divergence in the major commodity currency crosses. So let's find a little price point here. So let's just say, for argument's sake, that we have this, oh, let's go from the other side. I'm sorry, I did that incorrectly. We're going to take this high right here down to this low and find this little target area. So the 50% rule, if this trend really is going to maintain positive, like short term on a hourly and daily basis, we are in a corrective move higher. However, corrective move being the key term there. So if we look at as far as what would be the extreme for a correction, so let's just say we make another run at resistance. I would say that the likelihood of getting an extended rally higher is very bleak, to say the least. The only thing that I would say that would propel a big rally in the euro US dollar would be if the Fed doesn't raise interest rates, for one, and all of a sudden comes off the raising interest rate stand. If oil was to take a huge dive, and if there was some sort of mitigation, like I said, going on in the Ukraine, that could extend a rally for the euro versus the dollar. I don't think that's going to occur, but let's just say the algos get a big spike up here. I think that this would be your topping area, somewhere between 111.53 and 112.32. In this zone, I believe this is about the extent that you'll have of any correction. Also be mindful of the fact we had this previous low that comes right in this area, right below here. Also this low here comes in right in this zone. So where support now becomes potential resistance, it's right in this area, fits like a glove for that as far as any type of extended correction to the upside. Remember, we're in a bear market. Now, truthfully, yes, should we get up in this area, that would mean a higher move high after a higher move low. However, it's a corrective move right now. Now, could it be a turn and trend? Absolutely. It could set a bottom. It's very possible. Remember, we never try and pick tops and bottoms, and especially with all the fundamentals going on right now, it is more likely that the euro US dollar is going to make another run for support and batter that than it is going to breach resistance to the upside. So, sell rally is pretty much the forecast that we have for this market. We don't have any buy signal, that's for sure. Should you have any buy signals in your own systems or whatever that you have going on, methodologies if you will, the previous low, swing low here around 108.09 is key support. So if you're long right now, you have a very low risk buy. We're trading at 109.67. I mean, you're looking at, it's not a full dollar difference there, you know. I mean, so we have pretty decent amount of gap here, but your risk reward is the problem. So let's say that you are an aggressive bull and you say, okay, well, you know what, Teddy, I think we're going to at least go sideways to higher for the next few sessions to the next week, and you're willing to risk this low. What are you going to gain? Let's say you buy the market at 109.65 right now, okay? So 109.65 versus 108.09 would be, what is that? That's basically $1.50 of risk. So if you wanted to risk $1.50, proper money management would dictate that you would be making at least $3 basis points on this trade, meaning a 2-to-1 reward to risk ratio. So that would put this market at, just on a $3 basis, up at 112.64. So let's show you where that is right here. So if we go to 112.64, let's go 65. So this mid-range line here would be a minimal price target that if you want to be a long, if you're an aggressive bull against this new low, this would probably be the minimal price target that you would need. So that exceeds our target zone for an upside correction. So is it possible that we could spike up into there? Absolutely. Not outside the realm of possibility. Should we get up into this area? Does it make us bullish, this market? No, it would just mean this is probably, if you look at it, it's been going sideways basically since mid-November. We could say that we're extending the range of the sideways trade down to this area, and now we could consolidate back up around this area, very likely. Once again, with the war in the Ukraine, the sanctions and everything, fundamentally, it's highly unlikely that we're going to take out this, where is this? This high right here. So I can actually get rid of this Fibonacci thing. It's clearing up. All right, so this previous high here, which was the top of this range that we had for months, is probably very solid. I would really find it hard to believe that we would be going from where we're at now and rally all the way up to here, just because of the fundamental factors. Real quickly, if you look at the Treasury bond futures, they settled at 155.02 on Friday. Everything with the futures has to be in a lag, so by law. So now we are on the CME website, and we see this that the U.S. Treasury bond futures are now trading at 153.02. Why is this significant? Well, as always, excuse me, let's go to the 30-year bond, and let's put a line here, 153.02. So basically 153.03. So this is where the market is trading right now. Okay, significantly lower. It filled this gap. We rallied to the upside, had this little island, and boom, filled the gap on Friday. We start on Thursday and Friday of last week, and now we're extending the trade down. Remember, it's Fed Day on Wednesday. Odds are rates are going higher. That means bond prices go down. Bond prices, 10-year, all the interest rates, there's an inverse relationship. So when rates go up, prices go down. Also, that gives strength to the dollar. So besides the fact that we have flight to quality because of war, we have, if the bond market is a flight to quality place. That's why we had this rally here, because of the war. But that is just a blip. That's factored into the market. Now back to reality. Interest rates help to drive the price of currencies. They are a function of currency pricing. That is bullish. So with the Fed meeting coming on this week, if we do see a rally, it will be a creeper from today up until Wednesday. Come Wednesday, when they raise the rates, could we get an algo spike? Yeah, but I would be careful of that trade. That's why if you're not already in it right now, I would look to sell into a rally later on in the week at these higher levels. Do not buy into this rally. This is a very dangerous trade to buy into, because it's very likely that if we do spike up here, we're going to spike and we are going to slam back down here. Remember, this is the past from the beginning of February to where we are now into the middle of March. This is the biggest move that we've seen in months. Okay, so we finally broke out. Another thing to remember is that, why do we trade currencies? Currencies trend typically 70% of the time. They consolidate 30% of the time. Unlike most other markets, which consolidate 70% of the time and trend 30% of the time. So if that stays constant, we are now heading into a period of trending markets. So once again, we view the Euro US dollar as an upside correction. So real quick, let's just see if we have any questions here. No, we got a couple of likes on YouTube. Thank you very much. And I think we got a couple people on Twitch here, and hopefully you guys are hitting that subscribe and share button. All right, so now let's go to the US dollar and the pound. So GBP USD, let's see what's going on here. So British pound US dollar made a lower move low today. Question is, what's going to happen here? Are we going to set up for a short-term bottom? We never want to be a bottom picker or a top picker. Once we have a buy signal, it would be viewed as a corrective buy counter trend trade. So use caution buying in anything in this market right now. The fundamentals are a little bit mixed because of the price of oil. Now, we have had a little bit of a retracement. Of course, we're coming off of $120 oil. So to come back to the levels that we're at, we're still above 100. Go to the pump. I went there yesterday, so I know you don't have to tell you what's going on. You don't have to watch the charts to know where the price of gas and oil is. So, but the UK produces a lot of oil, the world's oil. So that the oil factor is neutralized with the U.S. because the UK is an exporter. We are an importer now. So that part gives the pound a little more strength than the euro. Since Brexit, the UK is no longer part of the EU. They don't have to deal with the Ukraine in the capacity that they would have had they not left the European Union. Now, does that mean they're not going to take on as many refugees? Could be. Does that mean that they're not going to give aid? No, it just means they're not going to be dictated to into what kind of aid they give. You got to remember, when it comes to military support for NATO, the bulk of it comes from the United States and the UK. So the question is how much support will they be lending to NATO? I got a problem with that one. I think that because of their separation from the EU and the buffer that they have between them and Russia, they will coordinate or be cohesive with most of the world as far as acting on sanctions, but they're not going to push it with the Russians. And also right now, they're making a lot of money off of oil, so they have everything to gain by this conflict that's going on there. They don't have any interest in subsiding things. Remember, they're not part of the EU anymore. So, big deal for the UK. This is one of the reasons why they wanted to separate from the EU and maintain their sovereignty. They've always kept their currency sovereign, but the government was not sovereign and the nation was not sovereign until we had Brexit. Because once you're part of the EU, remember that your government, whatever you have locally and within your own country, is trumped by the EU's leadership and their direction. So, British pound, US dollar, do we have a buy signal here? We do not have a buy signal yet. Right now, any sort of correction would be viewed as a corrective move. Any upside move would be viewed as a corrective move. So if we go from this last high down to the new low that we set today, let's see what kind of a retracement we could look for. So maybe we get a move back up. Now, remember, the British pound is not like the euro. Could they get a rally back up into this area? Be a very good area for it to head into. How is it likely that it's going to happen? Well, I think that once we get through Wednesday, it's very likely that we could see an upside correction here. Now, remember, there's divergence in the currencies. So the euro can continue to go lower. The pound can go sideways or even go higher versus the dollar because this is what's happening now in the world. There's so much disconnect and reconnect going on because we're coming out of lockdowns, and then the inflationary factor of commodities. Just like I always talk about interest rates, there was always a lot of comments from the viewers being like, he's always mentioning these other markets. Well, the reason I mention these other markets is because they are all integrated. They all influence each other. Besides the fact that they influence each other, to be ignorant of them also means that you're not protecting yourself properly. There are certain trends, like for instance, when we have right now inflation in the commodity markets across the board. Who benefits from that? There's always a benefit. There's always an upside and a downside. Net consumers, we're the ones that suffer. However, producers, production countries, they make out like bandits. So you have Canada that gives strength to the Canadian dollar. Believe it or not, Russia is supporting no matter what. It's going on. There's the war. There's sanctions. Obviously, the ruble is tanking, but it doesn't mean anything. The oil they sell isn't done in rubles. It's done in U.S. dollars and in euros. So especially with the dollars right now, they're probably using dollars more than euros. So when you look at these factors, they all play into each other. Even the grain markets have an influence on what goes on with the Japanese yen, which we will get to then. I'm highlighting each currency as we go along, and then as we get to the other ones, you'll see how much influence they actually have. Oil will be very big once we get to some of these other currency crosses. So as far as an upside correction, 133.25 up to 134.02 is about what we are looking for. Do I see it happening? I think it's going to be very hard to get a move up there in front of the Fed meeting. I think once they pull the trigger on Wednesday, expect a big spike in gyration. I'd be very cautious trading on Wednesday. If you're not already in a position and have a decent lead, the algos, it's most likely you're going to see a knee-jerk reaction where you could see a very big rally or a very big break and then have an opposite move all happen within a very short amount of time. Meaning that, let's say the Fed came out with an announcement today and raised rates. It wouldn't be unlikely for this range that we have right now to be extended below $1.30 and also be extended up to $1.32. You could have a $3 to $4 net range in the British pound on Wednesday because of the volatility. Once the stops get triggered, you got to remember, event days and news, when you trade events or news, like events like the war or the Fed meeting, which we already have a big expectation. Now, should they not raise rates, Would that cause the markets to gyrate a lot? A little bit. I think that once they do raise the rate, a quarter is expected, so that's factored in. Then the question will be is how soon will the next rate come? So that will be how I would say you'll probably get a bond rally after the fact, just a short-term corrective move, which would also influence the dollar, meaning you probably have a sell-off in the dollar should that occur. So if you get a bond rally, it happens, and if you see a 30-year and 10-year rally, it's very likely that the dollar is going to slide a little bit, and you get that little correction then for the euro, give them a little lift, and also the pound US dollar. As far as being an aggressive bear right now, if you're not already short, I'd be careful because it's very likely that we're going to grind around support here. I would wait for a rally to sell into. If like, that's what I'm saying, if you're not short already, unless you have a sell signal or whatever, follow your methodologies, don't listen to me, but remember that we are making a series of lower move lows, lower move highs on the intraday, on the daily, on the weekly, on the monthly. This is in a bear trend, so any upside move is a correction. Do not try and pick a bottom, especially with the fundamentals that are being changed by every moment. The biggest thing would be is if we can have a mitigated slowdown in the Ukraine with what's going on. Is that going to happen anytime soon? I don't think so. Not when Zelensky's asking for warplanes from jet fighters from the United States and other countries. So Zelensky and the Ukrainians, or excuse me, the Zelensky regime has no intention of backing down from this fight. The Ukrainian people are caught in the middle. This is just, believe it or not, for those who don't follow history or let alone follow what's going on in Europe, as a currency trader, you should follow what's going on all around the world because these things impact what goes on in the marketplace. The Ukrainian war, with the conflict with Russia, began just a month ago, but conflict in the Ukraine has been going on for a very long time, especially last summer. It heated up in a big way. Nobody talks about this. Everyone was worried about coronavirus, lockdowns, blah, blah, blah. Nobody cared about what was going on in the Ukraine or what Zelensky was up to. Now all of a sudden it's front page news. COVID disappeared. Now Zelensky is the hero of the world, putting on his Rambo outfit, and don't be just buying into that. I'm not going to get political on it. I'm not saying he is the Antichrist or he's the savior of the Ukraine. All I know is that he is not the most kosher of individuals, and this all could have been prevented. So now we can't play Monday morning quarterback. We have to deal with what's going on. So that's how it's going to impact these markets here. Now let's look at the U.S. dollar Swiss, another flight to quality currency, which, as you can see, isn't being a flight to quality currency. It's a big deal that the U.S. dollar Swiss has rallied as much as it has over the past week and a half. It came from the bottom part of its range. I mean, this thing has been in a chop suey wide range trade for months. Now, because of this chart and because of the range, if you look at it, it looks like it's been swinging around and had a lot of volatility. But look at the numbers. If you look at the low, this is back in November 3rd. Okay, so it's right around 90.86. And then the high was set at the end of November at 93.73. So just shy of a $3 basis move. So that also set the tone, the range. Now, we just fell short of that high today, looking to break out. Every time we've gotten close to this range, anything around 93, this market has failed. Now it is solidly above it, holding with making a higher move high, even though it's lower on the day. The question is, will this strength maintain? I wouldn't be an aggressive bull with this. I think that you're going to see a lot of sideways action, meaning that because of dollar strength and because we're moving into the Fed meeting, meaning that the rates are looking to go up, prices going down, that strengthen the dollar. So I think you have a bid going on in the U.S. dollar going into Wednesday. That's forcing the hands of the U.S. dollar Swiss traders. Because of the tensions in Europe, you got to remember, Switzerland did something that they have never, ever done just a little over a week ago. They joined in on the sanctions on Russia and froze all kinds of bank accounts and what have you. The Swiss historically have always stayed neutral in World War II, World War I, Korean conflict, Chinese Revolution, Russian Revolution, you name it, what have you. The conflicts have always been outside of Switzerland. They've always been neutral. They have not gotten their hands involved. They've washed their hands. They've dealt with the good, the bad, and the ugly. many people can say they don't like that, what have you, but there's neutrality does have its place in this world and is also a necessary evil. So that being said, you're seeing this artificial strength in the U.S. dollar Swiss right now, but I don't think you're going to see it continue to rally. Like, I've talked to some people about, you know, is parity something that's a reality? Is there that much strength in the dollar? What we're seeing right now, you would think that maybe in the midterm trend, like for instance over the next 3 months, could it be maintained as far as a bull and edge our way towards parity? I mean, parity from here is only less than $7 away, but it was contained in a $3 range for the last 4 months, 5 months. So that's something you need to be really mindful of. And once again, I mentioned how currencies trend 70% of the time, consolidate 30% of the time. U.S. dollar Swiss is due, and under those parameters should have a trend higher or lower. It should start to set a trend. Now this has had some good swings, but if you are mindful of the range, this is not a big deal. If this thing was trading on a $5, $7 basis handle dollar move, that would be a different aspect, you know. So to have one full dollar move, you know, 100 pips, this is only 300 pips. Big deal. Now look at some of these ranges like we had on this day here. Let's look at this middle, just arbitrarily here, from 92.23 all to 93.39 is over a dollar move in the Swiss. These moves were occurring when there was next to no action going on in the pound and the euro for the most part. So it's a lot of algo activity. This is a range trader's dream, what's been happening over the past 5 months. There's been very few valid buy or sell signals that have occurred, and right now we do have momentum to the upside. There's a lot of strength. Now, markets tend to go out like they come in. So with this boost that we've had in these highs, don't be surprised that even if we take out now, there's probably a lot of weak shorts that are selling into this rally against this high. There's no reason why the algos can't spike this up into Wednesday, get up to say even 94 even, but then come back down towards this 92.5. Very likely if dollar strength is maintained, and also depending on how the interest rates move afterwards on Wednesday, we'll see what happens. So sorry about that. Something going on outside the door. Okay. So we have the U.S. dollar Swiss. Once again, we have no buy or sell signal. As far as the upside range, I'd be cautious buying into. We're at the strength right now. It's very likely that we will have a corrective move and have a dollar correction coming up, which is something we should look at. Let's look at the Dixie. So as you can see, as we were on Friday, we made a big rally up towards these highs. Now, is it possible a dollar index hits 100? There's been a lot of talk about that. Absolutely. Once again, between the fundamentals of the interest rate market, the Ukrainian war, and everything else that's going on, overall strength in the dollar is very likely. However, look at the slope. If we hit 100, it will most likely happen after the Fed meeting and sometime in the next couple of weeks. Could happen in the next couple of sessions. As we get up into these higher levels, it's very likely that we're going to have a big reversal. Okay, so let's look at when was the last time we were at these levels and what gave us a problem. So we know that here's this high here. So let's look at, we had this high here, made this low here, made a lower move high and a higher move low. That has us in a sideways trade. So this is setting a parameters and a boundary. So even if we get above 100, it looks like we're going to have a tough time once we get up into this area between these two highs. So I would say that if we get above 100, this is going to become a very restrictive area. And as we get through some of these other currencies, you'll see what I'm talking about, because the dollar index is influenced mostly by the euro and the pound because of the biggest weights. So as the euro goes down, the index goes up in a big way. The pound could be flat or even going up against the dollar, but because of the euro, which is the biggest weight, that's going to give fuel to the US dollar. And as we get into some of these other currencies, you'll see that they are gaining strength versus the dollar, and it's most likely that they're going to continue to do so. So as that happens, this move that we've seen in the dollar's strength that's happened over the past, as you can see on a monthly basis, we go back to May of 2021 up until March. This is a 10-month rally that's been going on. We have a little bit more room to the upside. The slope is very steep. As you go up, you're going to run out of gas and correct and come back down. So it's very likely that we'll come up into this, breach $100 area, get up into somewhere falling short of this area or poking into it, and then come back down to 97, 95 as you get, once you do get a correction in the euro, and should there be a rally going on in the pound as well as the other major currency crosses versus the dollar, you'll see the dollar index slam in a big way. It'll spike off of its high and come down very quickly. So if you look at how it made this high, look at the range here. It was basically unchanged on the month, but look at the range. It went from 94 all the way up to 103. It's almost a $10 range in the dollar index, all within the course of 1 month. So the volatility is coming back. But once you have that volatility, expect to have a big range to the upside and the downside. People get chewed up during those markets. So unless you have a trade that's already in place and you're managing your risk well, be very cautious about when you do get into the market. Okay, so U.S. dollar Swiss, we're done with that. Now let's go to one of my favorite trades of the past couple sessions. U.S. dollar yen. We've been calling for an upside breakout in this thing for a while. It's been a creeper of a rally. I mean, I've been net long in this market since December, and nibbling around the last month and a half has just been a killer. You know, it started off 2022 with a bang, and then boom, as you can see, this thing just went poof, choppy, 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 choppy. I've been literally sitting on this position for months. As you can see, over the past couple sessions, I'm doing very well. Ever since we went from 116 now up to just below 118. I had 117.5 as a short-term target. We hit that today, and we are solidly above it. 122 is a target I've been talking about in my webinars, my videos. Also, if you see me on TFNN every Wednesday at 8:40 Central Standard Time, I'm on there for 10 minutes talking with Tommy O'Brien about the currency markets, commodity markets, and how they are interrelated and what's going on. If you look at any of the past videos, you can Google tfnn.com, cross-reference it with my name, and you can see that I've talked about these levels for a long time. So 122 is still in my sights. I'm staying net long. Like I said, I've been long since December, and I have been for these following reasons. Price of oil going up since December and going into now. You can see obviously what's happened in the oil market. Now, remember what we had in the oil market last week? We had a monstrous rally. So just to show you kind of what's going on with that one, we looked at the bonds. Let's go to XTIUSD. All right, so look at the oil market. Now, this is not the futures. This is the spot market. So look at this. We're below $100 a barrel. Isn't that amazing? But we're coming off 126. This is a big correction. Remember what I said before? Markets tend to come out like they go in. All right, just to make it visually clear, look at that. Look at this accelerated rally that we had in February. Boom, 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 boom. Pfft. Pretty much the same thing to the downside. Look at how that did that. Okay, let's move this to a little thinner. Okay. All right, let's get this out of the way. And look at this. From December of 2021, look at that. From December, we were at a bottom of 62.42. We more than doubled the price of oil from December 2nd to March 8th. How about that? Yeah, we know who did that. So now we have a lot of selling off. I think this is profit taking. Now there's also futures expiration. So for those of you that only trade the currencies, financial futures and commodities, there's commodities which are tangible goods. Financial futures are just financial commodities. That's the term futures is financials, commodities is for real stuff. So big profit taking in the oil markets, absolutely going on. Is it because of the new sanctions on Russia and the new deals with OPEC and what have you? Yeah, it's giving a little bit, but that's really a speed bump. A lot of what I think you have here is the velocity of the market, and you have expirations. So Futures contracts for financials expire every 3 months. It's March, June, September, and December. We are now in the March rollover. In the next few days, the March contract, March 22 contracts for all financials, whether it's S&P 500, currency futures, interest rate futures. Remember, we have a Fed meeting, and that's why expect a lot of volatility. Because of the expirations of the futures, you're going to see the cash market jump all over the place, and there's going to be a big disparity between the cash number, which right now we're looking at the cash oil, and then the futures. So if we go back to the CME website, we were looking at the interest rates. We go to energy. Let's take a look and see where energy futures are right now. So crude oil right now is trading almost at parity with the cash. It's trading at what is it, 100 and just over $100 a barrel, but it's down $8, almost $9 on the day. Okay, so obviously, as you can see, it is down that on the day. They're pretty much close in line right now, but over the past couple of sessions, they've been really wide. Now they're getting closer because you have rollover. You have rollover in the financials, and then you have oil, which expires monthly. So when you have that, you'll have your net long and short positions that have to be liquidated. If they want to maintain the short or long, they have to get out of the March and roll into April to keep their positions on. Then you have spread trading, which is where you'll be long one market and short the other. You'll be long 1 month and short the next month out, or vice versa, or depending on a couple months out. There's different ways of spreading. That's a lesson for another day, but I'm just telling you right now, this is something that's going on. It's going to impact the volatility. So as the futures expire going into Thursday, and the options expire, and then you have all these other rotations going on, you're going to kick up all kinds of stop orders in both the cash markets and also in the derivatives markets, whether it be the futures in the currencies or the interest rates, or in the real physicals also, like oil. Now Forex, obviously, those markets do not have a rollover. They have a daily rollover. So that's why you have either pay or receive interest, or sometimes pay on both, depending on where they're at. So that's the difference between those. So you don't have to worry about expirations, but you do have to worry about it when you're trading the Forex markets, because that will cause volatility on certain days. So expect, as we get into Wednesday and Thursday and Friday, because of the Fed meeting, rollover, expirations, these are going to cause a lot of churning around. So once again, if you're not long or short in any of these markets, unless you have a valid signal, buy or sell, that occurs, and then of course, obviously, follow your methodology, follow your signals. I am not telling you to not buy or sell any of these markets. I'm telling you to be aware of the situation so that you take that into account and don't lose money stupidly. Remember, trading is a business. Don't gamble. If you're gambling, then just go to a casino and bet on red or black at a roulette table and call it a lifetime. So all right, US dollar yen, we have an upside target. If you look at on the monthly, you can see how this is surging in a big way, and this is all occurring in the past couple of sessions. It's because before that, you could see how the monthly range, it was going sideways. The breakout to the upside 2 sessions ago, boom, here we go. We have volatility, we have strength, and I would expect that, are we going to just continue to explode and explode? Are we going to see something like this big rally here? We could. That would propel us up to 122. Now, I think long term, if the conflict in Russia and the Ukraine maintains, and if oil, right now it's coming off a big rally. It's doubled from December in 3 months, and now it's come back $20-some in just a few sessions. It's a lot of volatility. Oil futures, big margin on those contracts too. So this is going to help to support the US dollar yen bull. Okay, and unless oil comes back down to like $50-40, something like that a barrel, which I don't see anytime soon, and unless the Fed decides to cut rates or not raise rates, there's no reason to think that you're going to have a major sell-off in the US dollar yen. Nothing like that occurred back here in it's August of 15 going down into September of 16. That is not going to occur. Well, it could occur. I'm not going to say it's not going to occur, but it's very unlikely that it will. What will probably happen is we will continue to rally up towards 122 and then have a consolidation period for a few months. maybe for a few months because of the conflicts. Like I said, I'm hopeful that they can mitigate things down. Should they not do that, then, well, we'll be talking about how big of a rally this thing is really going to be, because it's affecting all kinds of markets. Wheat futures, I mean, what's going on in the grain markets, what we had going on before the Ukrainian conflict was one thing. Now, the wheat futures, corn futures, soybean futures, I mean, it's crazy what's good, the volatility, the limit moves that you've had in these markets. Now, wheat, why am I talking about that? That impacts the Japanese yen, US dollar yen. What do we have? We have wheat. What does Japan not have? They don't have wheat. They are a big importer of wheat. So as these prices of wheat goes up, corn goes up, soybeans goes up, boom, that's all priced in dollars. That gives strength to the U.S. dollar. It's not priced in Japanese yen. So that means that the bull, fundamentally, because of the commodity rally in the grain markets, because of the commodity rally in the oil markets, that is negative the Japanese yen. It gives them weakness. It gives strength to the U.S. dollar. So are we going to explode up to 130, 140? Probably not, but I think the 122 target is very, very likely. Okay, I could see a consolidation from 122 down to basically where we're trading now. That would occur for a couple of weeks. Very possible, very likely to have a profit-taking thing to occur, especially after the Fed move. And then after a consolidation period, unless things are mitigated once again in the Ukraine or what have you, these other and unless there's a depreciation in the commodity sector as far as pricing, there's no reason to not believe that the U.S. dollar yen will continue to be a bull and surpass 122 as a price target and get up to around 135 to 140 somewhere around the end of the year going into 2023. This is a long-term trade. I've been long for even before December, but it's because of what's going on. You can tell that all these other markets are trending. This situation doesn't just come to an end. We're not just going to flatline. Could the trends reverse? Absolutely. So that's where money management comes into play. Keep your stops tight. Know what you're doing. All right, let's see real quick. Just want to see if there's any questions on YouTube or on Twitch. No, there is not. Okay, for those of you that are watching, please make sure that you do subscribe and tweet out our video as well to your friends. So, all right, so for U.S. dollar yen, no reason to give you any lines or targets because there's nothing really there. Now, as far as a correction, should we have a pullback from where we're at now? Let's just say that today we put in a short-term high. Okay, so for a 50% and 0.618, this is pretty much the extent that we're looking for should we get a correction down into this area here. So that now this would be viewed as a corrective move. There is no reason for any sell-off or bearish move that even if it lasts for a couple of months in the U.S. dollar yen to expect it to be a very long-term move. I would not try and pick a top right now for sure because of everything that we've been talking about. So these are all very important things. Remember, you can't compete against the machines. You got to pick your points in the market. Money management is key, and stay disciplined. Treat trading as a business, and you will get good results. Gamble, which means you don't have any money management, let alone a trading plan, then guess what? You're going to probably have some nice upswings and think you're a genius, but over time, eventually, you're going to get blown out. So we're trying to keep you from not making those mistakes. That's one of our major goals here. All right, so we have one of our first majorly affected commodity markets. Majorly affected Forex markets by the commodity markets. Here's another one, Australian dollar, US dollar. Now, with the appreciation in commodity prices and also with the fact that Australia is coming out of lockdowns, they're letting their own people back into their country. Same with New Zealand. I actually know somebody who I spoke with last week who's been in America for the last 2 years and has not been able to go home and see their family in New Zealand, all because of the coronavirus mandates. Amazing how poof, it's all disappeared now. These countries, Australia and New Zealand, big commodity countries, they also supply China, very big, and the fact that the supply chain issues with China have been an issue. Getting commodities from which Australia, their major customer is China. So everything from oil to raw minerals, aluminum, gold, I mean, you name it, that's stuff that is coming back online. It's also the pricing in commodities has helped to give a lift of the Australian dollar versus the dollar. And that's the thing is I want you to take into account. Remember the euro and the pound, they're hitting support. Pound's trying to, it's not as weak as the euro. Australian dollar, look at this. It's been rallying. It's been going up against the dollar for the past couple of months. Well, price of oil is going up, blah, blah, blah. They're coming out of lockdowns. So once they broke this news about them coming out of lockdowns and now they're going back to work, which means they're going back to mining, which means they're going back to producing, which then it goes out into the supply chains, and we all know how that domino effect continues. That gives strength to the Australian dollar, US dollar. So I would be mindful of this. It's been in a bear trend for a very long time. I've been talking for the past couple of weeks about how we most likely set a bottom here. As you can see, we came on the monthly basis. We set a bottom here in March of 2020. We've been railing all the way up until February of 2021. We set a lower move high after a lower move low, keeping that downward trend intact. However, after this lower move high, we made a higher move low. So this low here is very key that we made just a couple months back. So right around 69.51. So any failure from that level would be counterproductive to any bullish sentiment. By attrition, now we're just coming really close to this upward sloping support line. It's holding the long-term trend intact. Could we fall down on it? Yeah, but I think most likely what's going to happen is we're going to bounce off of it. I think you're going to have a better chance of seeing Australian dollar, US dollar make a run for 80.16 and then start to try and break out to the upside. Now, if you could look at it as if you go back to 2015, that this market has pretty much been in a range right here for the most part, obviously, right? And we're right in the middle of it. So we did have this spike low here. Blame it on coronavirus lockdowns, I would. Now with the surge in commodity pricing, I think that's what has helped to establish this higher move low on a monthly basis, and it's going to give us a good idea of where the trend will stay. So if we take out the low from January of 2022 and we go back to the daily basis, make it a little easier here for you. If we do that, then we have a good chance at falling apart, okay? I don't think that's going to happen. The only thing I could say that would cause this bear market to come back would be that oil really tanks, our interest rate policy changes. I don't see that happening even remotely. These are the things that would have to occur for me to become a bear on the Australian dollar, US dollar. Now, am I a big bull? Not necessarily. I'm just not bearish anymore. So it's a buy break forecast. So coming off of this, now if you look at this, once we set this low here, we've been making consecutive higher move highs, higher move lows. We just made a higher move high. We're looking to make a higher move low. So as far as a fit, if you're going to be an aggressive bull, I would say here to 70.92, this is your key, which just comes right on this upward sloping support line. So if we fail from here, well then, market's in trouble. You know, obviously the short-term trend would be bearish. The long-term trend is still bearish, but the intermediate trend is sideways. And the fundamentals are starting to roll into Australian dollar strength. And this could come back, remember when I told you about the dollar index, where once we spike in these higher levels, the euro will hold the dollar index up. Now, do I think it's going to stay above 100? No, I think it'll come up to 100 and come back down, where the euro will be supporting the dollar index because it's weak, but currencies like the Australian dollar and New Zealand, which we're going to get to next, and the British pound, those are the ones that are going to weigh on the index and keep it from exploding up into the higher, you know, above 100 for the dollar index. So if we look at it for a correction here, we go from our low here to our high here and our 50%. Now we're close to it. And if you think about the next couple of sessions, if we have dollar strength that continues going on into the Fed meeting, and especially if oil upticks again, or if oil, if oil doesn't uptick again and going into the next few sessions, then this correction right now, this current sell-off, probably will come down into this area here, somewhere between 71.53 and 72.02. I think that this is the extent of it. It's right above this upward sloping support line. It's keeping the trend intact. Unless, like I said, unless we have a big reversal of these other fundamental factors, the technicals right now are showing that this is about the extent of a sell-off, and then we should have another either consolidation or run at resistance. Remember, overall bullish on Australian dollar, US dollar in the short run because of them coming out of lockdowns and all kinds of other things that were suppressing their currency. Those variables no longer exist. As you can see, volatility in New Zealand is not quite the same as it is in Australian dollar. Very similar forecast. Now, their restrictions are still they're letting people back into the country, but they're still having really big lockdown restrictions, meaning that and this is something I don't get at all, is that you have people, if you test positive coronavirus, you have a 26-day lockdown, or 21 to 26-day where you have to be in quarantine. And anyone that was in contact with them, too, through contact tracing, can fall into that category where they, even if they test negative, have to go into quarantine for 26 days, or 21 days. It's over 20 days, whatever it is. That restriction hasn't been lifted yet, as far as I know. Maybe it was over the weekend, or maybe it is today, but it was in place still. That's a little more restrictive. I don't think you're going to see New Zealand dollar, US dollar continue to rally in a big way until those final restrictions are lifted. If they happen sooner than later, then I would say it will maintain a buy dip posture with an aggressive stance towards challenging resistance and making higher move highs. I don't think you're going to see the extent of volatility like you're going to see in the Australian dollar, just because the Australian dollar is a bigger currency, bigger continent, for Christ's sakes, not just a country. You'll probably have more action there for as far as margin's sake and for volatility's sake. You're going to probably see a lot of interest in New Zealand dollar, US dollar, as they start to come off these lockdowns, especially with commodity prices, with their inflation. And there's no reason to be negative. So I would look to buy dips if you're going to go and be a bear right now. Just be mindful of the current highs, especially right now. If you're an aggressive short right now, I wouldn't even be keying off the 69.26 area. I would key off the high from 3 sessions ago, around 68.72. Just because right now you're trending higher move highs, higher move lows. It's more likely that you're going to be setting a higher move low and then make a run at resistance. Now, how much upside is there? I don't see any major trending upside potential. So you reward the risk factor right here. I would look to buy a decent break where you can have more bang for your buck, where you have a good chance at making 2 to 3 times or more reward to the risk that you are putting up. And those are the trades, honestly, that you always want. You got to be careful, be mindful of when you do put on trades that you may have a very good buy or sell signal, but if it doesn't fall within money management parameters and risk parameters, those are trades not worth taking, because over time your losses will not be effective enough to counterbalance your account. You'll end up, your profits will diminish very quickly, and you'll be stressed with margin issues because of that. You won't be able to keep your equity curve trending higher on a nice slope because of that type of money management. So if you have read my book, High Probable Japanese Candlestick Patterns, there's a whole chapter developed or dedicated. Excuse me, I can't talk. My mouth's a little dry. This probably would help if I have a little water. If you have, excuse me, I have a chapter dedicated to money management. That is worth the price of the book, actually more than the price of the book in itself. Forget the rest of the methodologies and learning that you get out of the book, and especially how to utilize the patterns and trade with them. The money management can be applied no matter what you're using. So you don't have to use the same indicators I use. You don't have to use the same methodology I use or that anybody else uses. But money management is the same for everybody. It's a constant. You either use it or you abuse it. And if you abuse it, you're gambling and you're just wasting your time with whatever you're doing in your trading experience. But with proper money management, then you give yourself the biggest opportunity for success, especially because you take the trades that will absorb your losses. When you're making 2 to 3, 5 times what you're risking on any given trade, you're going to have losers. However, those wins wipe out more than one loser. So you have a better chance, especially when you're making 3 to 5 times, that cleans up 2 to 3 bad trades and still leaves you a positive. So, and these are the things that you overall need to understand, and also how much you trade with as well. One of the biggest things that people don't do properly is trade their account size rationally. They overtrade their account, they get into margin troubles, and then all of a sudden they lose a lot of money very quickly. And then when they have very good opportunities, they either don't have the money, the capital to jump on them, or they can't utilize them as to the extent to which they were able to do before. So be very mindful of that. If you are a beginning trader, I highly suggest that you read that chapter of my book. That itself is multiple college courses don't even give you that much information. So it's a fantastic chapter. Not to toot my own horn here. All right, so New Zealand dollar, US dollar. There's that. Now let's go to US dollar Canada. This one in the short run is trending higher. It's very neutral today. I would not expect very much because of the interest rate trade and the oil trade, which is kind of counterbalanced right now. Hence, not a lot. I would expect if we have this kind of volatility today, which is next to nothing, and this consolidation, that it's a buy dip scenario in the short run because it is short run bullish. There are some reasons to get negative. Should we have an extended sell-off in oil, that could put a little weakness on the Canadian dollar, which then would help to bring the US dollar Canada up to challenge resistance and maintain the trend. But let's just say that for whatever reason we start to make a run for new highs and we take out this last higher move high. Well, we have this one back here from December coming close to challenging that one. Very likely that you are going to have a lot of resistance in this area. I could see it, like I said, if the dollar remains strong and oil, if that remains weak, then it's likely we will challenge these levels but not explode through them. And also expect that as we pop above them, that we're going to have a correction. So just like we were up here and then came with this big correction here, it's very likely that we will make new highs, make a higher move high, confirming that bullish trend, and then have a big bearish correction. But it'll be a correction. Right now, we are not overall bearish to US dollar, Canadian dollar, until we see a big sharp turn in the dollar index. If that happens, and all the other currencies start to weigh on the dollar, then it's likely that Canada, in a short run, will gain momentum, meaning you'll see a US dollar Canada sell-off. Right now, I'm looking to buy breaks and also looking for a valid signal. This here is a key low. If we take out $1.2586, then I think that the range that we've been in for the past few months, you're going to extend the slide and hammer support down towards probably where these lows are here. And then this is where I think you're going to find a consolidation. I don't see how the US dollar Canada is going to break below here unless our interest rate policy changes, and that's not going to happen. Now, should the Bank of Canada all of a sudden start to aggressively raise rates, well then it's very likely that the US dollar Canada will stay sideways or even take a nosedive. So that could happen. So be mindful of not our Fed, what it does, but what their Fed, what their bank, central bank does. So for US dollar Canada, let's see. Oh, here we go. First time, best followers prime, blah, blah, blah. All right. Okay, nice. Thanks for leaving a comment there on Twitch. Appreciate every comment. Let's see, on YouTube, got a like, and looks like we got a couple shares too. Thank you very much, guys. Pretty quiet day today. So, all right. So US dollar Canada, let's take a look at some cryptos real quick. BTC, USD, we're going to fly through this. Bitcoin going kind of sideways, just churning and burning here. Not much to look at. There's a lot of news here. Bitcoin, as far as Mexico and now acknowledging it as a currency and what have you. There's a couple other countries that are jumping on board, but then there's also countries that are talking about not accepting it at all and having nothing to do with it. So there's a tug of war going on there, teeter-totter effect, if you will, up and down. And right now the volatility is not that strong. Right now you got to wait for a signal. As far as being overly bullish or bearish, I think that right now you're consolidating and you're more likely to hit support than you are going to make a run at resistance. It seems to be that once you get above 40,000, that your likelihood of buyers is running out of gas, at least in the short run for Bitcoin. All right, so let's look at Ether. This one here is also grinding support. Now it's wedging. Now, could we get an upside breakout? Absolutely, we could. Is it going to happen anytime soon? Well, it could happen today, tomorrow. It could happen a week from now. Is the Fed meeting something that's, causing these markets to consolidate and drop the volatility? No, I don't think so. I think that you got to realize that now, as we have restrictions, the Russians are very active in the crypto space. So are a lot of other countries that, as you can't move things to and from or deal, they're worried about, moving money between different countries and trading with them and, having certain trade deals done via cryptocurrencies. It looks like it's causing a flatline, meaning that there's a lot of action that normally probably is happening in the crypto space that on a day-to-day basis none of us really think about, and obviously it's drying up. At least that's my perspective right now going forward for the next few sessions in the next couple of weeks. Ever since the Ukrainian war started, you can see that all of a sudden this is becoming very stable. It's not much of a range compared to, it's not trending either, which is not like how this market has been trading. So when you look at it, look at this volatility. Now look at this, as we come up, we came back. Remember earlier, for those of you that were paying attention to the webinar, markets tend to go out like they come in. We had this sell signal here back in December of 2021. We had the follow through. So let's just see if we go from there to there. How far are we into our range? All right, here's the 50%. And here's the 0.618. So we've already been bobbling around the 50%. Remember, 50%, whether it's Fibonacci, it's Gann, it's also a gravitational pivot point for trading. It's been existing from floor trading to trading all across the span of history, actually going back a couple hundred years. Is it always a pivot point? No. Is it always a target? No. Is it always viable? No. Does it work a lot of times? Yes. Especially when you are looking at, if you're paying attention to the trend, corrections typically do not extend beyond the 50 or 0.618 level of Fibonacci. A lot of them hold around, or if you're looking to get back into a trend, like long-term trends, especially like this, we came into a nice buying area. So support based off of this tells me that we're set for a lot of sideways action. Remember, look at how we went sideways from 18 all the way into, for 2 years, this market went nowhere. Then, in the period of 2 years, it exploded from less than 500 to 4,500. And now we're not quite in the middle of that move anymore. So, when you look at it on that basis, a lot of volatility in a short amount of time. Markets go out, then they come back like they come back like they go out like they come in. Now we're done with that period, consolidation time. And then what happens from there, we shall see. Will we get another rally? I think that even if there's an overall bearish reality to Ethereum and Bitcoin over the next couple of weeks, months, or even years, it's very likely that you're going to have a big rally still. Remember, you get your biggest rallies in your bear markets and your biggest breaks in your bull markets. So if you haven't been paying attention the last couple of years, take a look at the S&P 500 chart, and that will definitely tell you. We definitely have got some of our biggest breaks in the bull markets. So anyhow, Ethereum, US dollar, going kind of sideways, obviously on the monthly basis, getting hit on a daily basis, though, kind of consolidating. All right, now let's go back to the Euro US dollar. Take a look at this real quick. Do another walk around the world. Okay, so now the market actually is just below its highs of the day. So a little bit of strength, a little bit of pullback. This is profit taking. Remember, the dollar's on a tear right now. Once again, I would not get bullish the euro US dollar. Excuse me, my voice is. Here we go, much better. All right, so dollar having a little bit of a sell-off, a little bit of a corrective move today. I wouldn't take too much stock on that one. Be mindful of the Fed once again. A lot of volatility. We have futures and option expiration this week, with rollovers happening across the board besides in oil, but not in the rest of the financials. So we had a little lesson in futures and commodities and how that interlocks with the Forex markets, especially like, once again, US dollar yen. We have oil that impacts it. We have wheat that impacts it. So there's two commodity markets. Then we have the interest rate market. There's a financial market. So remember also, if you've been a follower of mine, one thing I always say or answer when people ask me, what's the best indicator that you like to use? Well, I always say the market. The market is always the best indicator. So when you use these other markets, they're in real time. There's no lag. So there's usually, if anything, there's actually, you can see divergence, which helps to signal shifts in trend, and there's also where one will start a little bit ahead of another, and once it breaks out, that helps to confirm for the currency markets where strength and weakness will start to ebb and flow from. So these are all variables. As you grow as a trader, it becomes second nature. A lot of what we cover is in depth. There's a lot of moving parts, but that's how you pick the right trades. Remember, not trading is also trading, and money management is the key to trading. So the hardest part about trading is not getting into the market. It's how and when you get into the market and how and when you get out of the market. So, and there's a lot of times where, you know what, there's a lot of action going on. That doesn't mean you're going to pull the trigger. You should stay out of the markets. Yes, is there opportunity? Does that mean that you're not doing the right thing by not taking advantage of it? No. Sometimes opportunity is there, but it's not a good opportunity. Why would you participate in something that's going to cost you money? Doesn't make sense as a business, does it? So, all right, we don't have any questions on Twitch or on YouTube today. All right, but we had some little viewers, a little quiet today. All right, so for all of you out there, I want to thank you guys very much for your time today, taking a little time out of your day. Don't forget to, oops, that's not what I wanted, the book promotion. There we go. If you haven't done so already, subscribe to our YouTube or Twitch channel, Forex Trading Unlocked, and also check out the book written by myself, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And once again, I'm Teddy Keckstedt from Forex Trading Unlocked. You can check us out every day at forex-trading-unlocked.com. You guys have a great day.